I'm Ksenia. I'm with Future Home Realty,
Hey guys, I'm Morgan Gall with Supreme Lending.
and we are here doing our credit seminar. So thanks to everybody that could come, but to those that can't, thank you for watching.
All right. So we're going to talk a little bit about some credit stuff today. We're going to try and keep this a little shorter than the last time.
Yeah.
So, Ksenia, do you want to talk a little bit just about you and being a realtor?
Yeah, definitely. So I do real estate. I used to do civil engineering, but I wanted to do a career where I was a little bit more involved with the people and helping them through this big decision. And I wanted something where I was learning something new every day. And this is great, and this is perfect for that. So I'm really excited. I really love real estate, and I work for Future Home Realty, and I really love first-time home buyers. So we're hopefully going to get you guys all on track to fix your credit and buy your first home.
Cool. All right. So, like I said before, I'm with Supreme Lending. So we're going to talk a little bit about credit, and I'm going to try and not keep it specific towards buying a home, even though that's kind of what we're talking about.
Yeah.
But let's talk just a little bit about credit as a whole. And when I think about credit, and there's a lot of unknown when it comes to credit, and even no matter how much you think you know about credit, there's always something that you're going to learn about it.
Yeah.
And I think when we look at an investment like buying a home, where credit is such an integral part, there's because there's so much unknown, there's a lot that just people can feel overwhelmed with.
Yeah.
And whether it be that you don't know if you have enough credit, whether your credit score is good enough, there is so much of that is just flat out, it's difficult.
Yeah, and there's so many resources online that do help, but when you have too much stuff going through your head and too much things that you read, it gets overwhelming. So we're here to kind of pick out the stuff that you really, really need to know and narrow down the focus for you.
Yeah, absolutely. If we think about this being a funnel, we're just trying to get you a little narrowed down on that, right?
Exactly.
So let's talk a little bit about credit score. So we've got for the people who are here, we've got a cool little printout, just a little bit of basic information about what goes into making up a credit score. And let's see if we can.
Yeah.
Oh, this is backwards on that.
It's okay. We'll post this image for you guys.
Yeah.
But yeah, it's basically a nice little pie chart. I'm a very visual person, so we thought that this would help kind of get the bigger picture of what goes into a credit score. And we wanted to hit on that because you got to know what you're actually fixing. So to know what you're fixing, you have to figure out what goes into it and what matters the most, so you can focus on fixing the things that are going to affect it.
Absolutely. Yeah. And part of that knowledge is knowing what actually, just from a statistical portion of what makes up your credit score. And that's what we like about this one. So for those of you who have the printout, and when we post this up later, so it just breaks it up into really into 5 main categories that we've got here. And it just kind of gives a rough idea of percentage of what that does with your credit score. Now below that, and here in just a moment, we're going to talk a little bit about the specific ranges of credit scores to give a little better aspect as to kind of what's good credit and what's not. And so going over this, the one item, and this probably should not come as a surprise if you have any idea about credit, the one item that makes up the largest portion of your credit score is going to be your payment history. So on this pie chart here, it's given 35% of your whole credit score is weighted towards payment history. So payment history is pretty self-explanatory. It's going to be on-time payments. And that's it.
Yeah. So it is a big chunk, but as you see it, it's not even half the percentage of the whole credit score. So it does constitute for the biggest portion of it, but there's so many other things that go into it. So if you have a bad payment history and you've had some trouble with that, there's other things that you could focus on that could help.
Absolutely.
Yeah.
Absolutely. And that's the one thing in this, when you look at the weight of payment history, the one thing that my takeaway is that, just like you say, there's a lot of offsetting factors. The other portion to that is that if you want to start making an immediate change to your credit score, there's a great item to work on. And it's I don't want to sound like just nonchalant about, oh, just pay your bills on time. But if you're focused about your credit score, that is going to carry a lot of weight. And we can look at any credit situation. I don't care what your score is, how bad it is, how much you put your shoulder into getting your credit score as bad as possible. There is a way to fix your credit. And all it comes down to is just how much time it's going to take. So there's a quick item right there. When we look at the weight of credit, payment history obviously is going to be a big factor. Now the next thing, which is almost equal in weight, so this graph is saying 35% hit to payment history. 30% is credit capacity.
Yeah, so that's a big chunk.
That's a huge chunk. So now what capacity is looking at is they're looking at how much available credit you have. Now, this comes in two factors. So you can have a lot of credit available to you, but you can be utilizing a lot of it. Now, that's going to hurt that capacity. Now, when I look at people's credit, when they're looking to buy a home, that's one of my first opportunities. If I need to try and massage their credit score a little bit, I'm looking at their capacity. So I'm looking at, hey, are you maxed out maybe on a credit card? Maybe we can get a couple extra points very quickly and move on with your home purchase.
What's recommended typically is use 30% of your credit limit, up to 30%. So that's a good marker for you guys to know.
So, and I think if you look at that 30% item, if you want to get your spending below 30%, now if you're trying to still get the absolute maximum usage of your credit, I'm typically going to recommend to get below 10%. Now the reason behind that is that as we hit these markers going down on that capacity level, your capacity, the amount of credit you have available to you, continues to increase. So if we get down below that 10% range, now your capacity looks even better. And that's the whole idea. So just to bring this one back up, so this is the credit capacity here. At 30% on this chart here, man, that's a huge advantage. So sometimes even with some poor payment history, maybe you can offset that by bringing down the debt. There's so much power in that. We could probably spend a whole time talking about capacity, but we want to talk about the whole mix of credit here. So let's go to the next item here. And this one I don't think a lot of people really invest much time thinking about. But this is, so on this one here, this is saying 15% of your credit score is brought up with length of credit.
Yeah, so if you just started using credit, then that's going to, like if you've had a credit card for a really long time, you should keep that open because that affects your credit history like 15%. So it's a lot,
And that's the length of credit, as you have credit for a longer period of time, these are all offsetting factors. If we look at this whole pie chart, everything works together to bring up your credit score. So if we have negative items in certain areas, everything is going to work in your advantage. So length of credit, the longer you can have an open credit card, a loan, anything of that nature is going to be helping you.
So that's why it's kind of hard for those people that don't have credit cards, and then they compare themselves to people that do have credit debt, but then their credit score might not even be as good as those people with debt because they just don't have the history. Because the banks wants to see that you use them, and they want to give money to people that are going to come back and use them again.
Absolutely.
That's essentially
and that's
what they're looking for.
And that's a very good point. So this kind of couples in. So we've got the length of credit here. That capacity, that's another thing right there where, the banks want to know that you're lendable, you're credit worthy. And those two items really piggyback to each other because they're going to look at, hey, okay, you've got good history with a credit card or a line of credit or something of that nature. That all comes down to credit worthiness. Almost so much so that we could almost blend these together. This is 45% of your credit score. And so there's a lot of times where we talk to people about increasing their credit score, and we're going to tell them to assume more debt. So we're going to talk to them about opening up a credit card or a secured credit card. And the whole reason is that we want to increase their capacity. So we want to increase how much credit they have available to them. And then we also want to continue to build that length of credit.
Do you want to touch a little bit more on the secure credit card
We'll talk on that in just a
Okay.
moment. So the so that's with length of credit. The other thing that I'm going to mention with that is that when we start, if we kind of zoom in on getting a home loan, there's going to be a lot of loan products out there where people have great credit scores, but they don't have enough length of credit. And so there's times where we look at certain people and they don't qualify for certain loan products just simply because they haven't had credit long enough.
Yeah.
And those are people who are typically going to be, they don't have 2 to 3 years of credit. And that does happen. It's, there's no line in the sand with everything out there, but that does happen very often where we just have too much new credit. And so we need to look at some other loan options. And we'll see that no matter what type of loan product you're looking for, whether it's a home, an automobile, even certain credit card companies won't give you certain credit cards until you've had credit for a long enough amount of time.
Yeah.
So so that's a little bit about length of credit here. So let's go to the next item here. So we're going to talk about accumulation of debt. So this is pretty straightforward. This is funny enough. This kind of piggybacks to length of credit because they're going to be looking at when you've opened credit, credit cards, lines of credit. This is just saying how quickly you're trying to accumulate debt. So there's some risk involved with that. So if we have somebody who has not had credit and then they've gone out and they've tried to apply for 10 credit cards, that can have some negative factors. Now the other thing that's going to piggyback with that are credit inquiries. So that's anytime somebody has checked your credit, anytime anybody has pulled any full credit report. So not a soft inquiry, this is a hard inquiry where you're shopping for a product. So these are typically going to last, for this, in this scenario, this is going to give you about 12 or a year to a year and a half that this is going to have effect on your credit. Now, I will tell you for credit inquiries, because I do get this question quite a bit, typically credit inquiries are going to have a little bit of a dip, and then it's going to come back typically within about 1 to 3 cycles for most credit bureaus, so 1 to 3 months.
Yeah, and what's a cool fact about that is if you're shopping for a mortgage within the mortgage industry, if you've had a couple lenders pull your credit, it's not going to count within 30 days. So it's only going to count as one pull, as long as it's within 30 days in that same industry. So
Yeah, exactly.
A lot of people get scared when they're trying to shop for credit, but they don't want their credit score to tank. So it will drop a little bit because of the first credit inquiry. But then if you go to a different lender to see if they have a better rate or a better program for you, then that should be okay within 30 days.
Absolutely. So the credit bureaus give you 30 days to shop for the same product.
Yeah.
And so that's, that is in your advantage. Look at loan programs, look at offerings out there before you make your decision. So the last thing on this graph here, this also is 10%. So this is mix of credit. So they're looking at just the type of accounts that you have. So if you only have a few credit cards, that is not going to be as powerful as somebody who has some credit cards, an auto loan, a student loan, some type of an installment repayment plan. Those are going to show that you have, I typically call this depth of credit. This means that you have a lot of items out there that you have applied and been approved for in the past. So this all comes into, I feel like I say this all the time with people, but this is credit worthiness. This is, this is being able to say from a financial position that somebody should lend you money.
Yeah.
And that's, there's a lot that goes into that because sometimes you can have very strong credit scores but not have very good credit history. And those are going to be back to those scenarios of that length of credit, or maybe you don't have a lot of capacity. So there's a lot that goes into this. So that's just kind of a little quick overview as to what makes up the credit score, because I feel like there's kind of I want to say there's just like a black sheet over the whole idea of what goes into credit. There shouldn't be. Credit should be something that's attainable by everybody, and it certainly is. But it is definitely something that you've got to work on, and knowing what makes up that credit score is super powerful. And it's I think it's one of those things that you just absolutely can't work on enough.